Chapter 4. So in Chapter 4, we finish off the accounting cycle. And I don't know if y'all remember, but actually let me delete that. But back in an earlier chapter, I talked about the 8 steps of the accounting cycle. And the first step was to journalize. I think I probably talked about it a couple times. Journalize daily. Oh my gosh. Transactions in the journal. The second step was to post to the ledger. Post to the accounts in the ledger. The third step was to prepare a trial balance to make sure that your debits equal your credits. The fourth step was adjusting journal entries at the end of the month or the end of the year, whatever the time period may be. And it was adjusting entries and post. And it was an adjusted trial balance. Then from that, you can prepare your financial statements. Then we're going to do closing entries and post, and then a post-closing trial balance. So we've pretty much done everything except the closing entries. All right. We are going to talk a little bit more about the financial statements in this chapter as well, and that's what this first little lecture is. But I think we're going to have basically 3 lectures here. We're going to have one over the financial statements, one over closing entries, and then another one that does the worksheet, which is in this chapter as well. All right, so we've already talked about the financial statements, but the financial statements, if you recall, are the income statement, which shows revenues minus expenses to get to net income or net loss. And there's the statement. We've been doing statement of retained earnings, but the statement of owner's equity, which shows changes to capital, we've been doing changes to retained earnings, and we're going to stick with that. All right, you tend to hear owner's equity more when it's a sole proprietorship, and if you're dealing with corporations, it's statement of retained earnings. However, most corporations will do a statement of stockholders' equity, which shows changes to all the equity accounts, not just retained earnings. All right, but this shows changes to her retained earnings during the year. And then a balance sheet, which basically shows us our assets, liabilities, and equity on the last day of the period, the time period, whatever it is that you're looking at. All right, so the income statement and the statement of retained earnings cover a period of time. The balance sheet is just a point in time. Now, the trial balance is already set up to make this easy. So I just copied this over so I can just kind of point to it. You know, when you do your adjusted trial balance, you go through the general ledger, and everything in the ledger is in financial statement order already, starting with your assets. So when you're looking at the adjusted trial balance, these accounts are already grouped basically by how they go on the financial statements. So cash through notes payable in this case, these all go on the balance sheet. And if you notice, it's your assets, then your liabilities, and then your equity accounts right here where it has capital. All right, these equity accounts will show up on the statement owner's equity. This one is a sole proprietorship, the Smart Touch Learning. And then you have your revenue and expenses, which go on the income statement. So it makes it a little easier to prepare the financial statements because everything is already right there, ready to go. All right. Remember, though, that you have to prepare the financial statements in order. All right. So we must prepare the financial statements in order. Because net income will flow to the statement of equity. I'm going to say retained earnings since that's what we've been doing. So net income will flow to the statement of retained earnings to help find the new balance, I'm going to put updated. Balance and retained earnings. And then this updated balance updated retained earnings balance flows to the balance sheet and if you use the old retained earnings number, the balance sheet will not balance. All right, so everything needs to be done in order. All right, so you do the income statement first and get net income, and then that net income flows over here to the equity to update equity, and then that updated equity number, this 51,550, that updated equity number shows up on the balance sheet and makes it all work out. Okay, now a new thing that we are going to do is classify the balance sheet. Okay, so we're gonna learn a classified balance sheet, and this is what will be on the next test. Not just a regular balance sheet, but a classified balance sheet. All right, so a classified balance sheet further categorizes the accounts by type. All right, so assets are ordered by liquidity. All right, so items that will convert to cash quickly or be used up soon, they go closer to the top. And then liabilities that have to be paid sooner will also be closer to the top on the liability section. Liabilities that will have to be paid soon will be closer to the top under liabilities. Now we're actually going to give names to these classifications. Okay, so our assets, let me just move on and do that. Right here. All right, we'll have several categories of assets that we're going to be dealing with. All right, the first one is current assets. All right, current assets will be converted to cash or used up within 12 months. I'll put 1 year. Within 1 year or the operating cycle, whichever is longer. All right, the operating cycle, let's see if I can draw this out. Okay, for the operating cycle, you start off with cash. You in our case, we're just providing a service. And then you collect the cash. Well, let me do it like this. I'm a little afraid to do this, but we'll try it. All right, so we start with cash. We provide a service. All right, and then we collect the money and go back to cash. So this circle basically is my operating cycle. And generally it's less than a year. All right, for instance, if I'm doing somebody's tax return, they're going to bring me the stuff on one day. I'll provide the service the next day, and I'll give them the return back, and they pay me. So that's, pretty fast, a couple days. So generally, we will use 1 year, right? And in this class, we'll use 1 year as our rule of thumb for if something is a current asset or not. This could be a little bit longer depending on what we're doing and what type of service I'm providing. So for instance, if I'm building aircraft carriers, it'll probably take me a couple years to build the aircraft carrier. So in that case, my operating cycle would be longer than a year. Oh, excuse me. All right, so types of current assets. We would find cash. Cash is at the top of the list. All right, account receivable. Inventory, which we haven't really gotten to yet, but I'm going to put it in here. All right, inventory. Office supplies, not because they're going to convert to cash, but we're going to use them up within a year more than likely. Prepaids, so like prepaid rent, prepaid insurance. Those are examples of current assets. Okay. Items that are not considered current assets, because they have a life of more than 1 year, they're going to last longer than a year. Those are long-term assets. And they basically will last longer than a year, or the operating cycle. One of the main ones that we'll be using in this category are plant assets. All right, plant assets are the assets that we use to run our operations. All right, we typically put it into an account called plant, property, and equipment. And I usually call it PPE, all right? Not to get confused with the PPE during the pandemic. All right, it's plant, property, and equipment. And it's going to be things like land, buildings, your accumulated depreciation would go here as well. Remember, you're going to subtract it out, though. So your accumulated depreciation on that building, equipment, any accumulated depreciation on that. Vehicles, any accumulated depreciation you might have furniture and fixtures, any accumulated depreciation, and so on and so forth. All right, you'll get my drift. So any type of long-term asset that you're using in your operations goes under plant, property, and equipment. Oh no, I can't quit yawning. Why can I not use my cell pointer? All right, then you might have long-term investments. All right, this is where you invest money in order to make money. All right, such as interest or dividends. Oh my goodness. Interest revenue or dividend revenue. And there's way more to it, but we'll talk about all that later. All right, so things in this category might be an investment in XYZ stock, investment in debt securities, which means that you have basically lent somebody money, or perhaps a long-term note receivable. Note receivables are where you loan money to somebody, and if they're going to pay you back over a longer period than a year, then it would be a long-term investment. Okay, you might, and you're going to collect interest on it. What is going on? You might also find a note receivable up here under current assets as well. If they're going to be paid back in a shorter period than a year. Paid back to you. It's where you lending somebody else money. All right. And then there's others, but we'll just stop at that at the moment. We'll add more in later as we go through. Oh, you know what? It's because I have this thing on. Next up is liabilities. All right, under liabilities, you're going to have current liabilities. Which follow the same rule as current assets. All right. They need to be paid within 1 year for the operating cycle. And they'll be paid with current assets. Cash, for instance. All right, generally they'll be paid with current assets. All right, or you might provide a service. To satisfy the obligation. Well, I got that a little long over there. Let's Alright, so current liabilities typically include accounts payable. Really, almost anything with the word payable after it that has to be paid, pretty quickly. Most current liabilities are paid within like 30 days. Some might take a little bit longer, but for the most part, they're pretty fast. So account payable, wages payable, utilities payable, etc. Unearned revenue is also generally considered a current liability. In this case, you don't have to necessarily pay it back with cash, but you have to provide the service that you've already been paid for. We've talked about that before. All right, long-term liabilities. Sometimes I say non-current, so if I say non-current liabilities, don't get confused. Long-term liabilities are due past a year. And typically there could be a note payable. You might also have a note payable up in the current one if it's due within 6 months, let's say. But note payable, mortgage payable, bond payable are all examples of long-term liabilities. And then equity stays the same. We're not changing anything with the equity. For us, we'll be doing common stock and retained earnings. We will add to this later, but not in this chapter. And that is that. Here they give you an example of a classified balance sheet. So you might want to look it over, and we will be doing one in the exercises.